Before we look at charts, before we zoom into the next candle, I want to step back for a moment because something important is happening in the background of the markets right now, and most people in crypto aren't really talking about it properly. Japan. Over the next week, markets are focused on the Bank of Japan and specifically whether they raise rates, how they communicate it, and what it means for global liquidity. And I keep seeing the same question come up again and again. If Japan raises rates, are we going to see a drop? And historically, what actually happens when this occurs? Because price already feels heavy. Rallies aren't holding, volatility feels different, and people are starting to wonder whether something bigger is going on under the surface. So let's talk about it. Calmly, logically, and without the usual crypto panic narratives. If you're new here, I'm Paula. On this channel, we talk about crypto through the lens of macro, liquidity, and market structure, not just hype and indicators. The goal isn't to predict every move perfectly, it's to understand the environment we're operating in, so we stop being surprised by price. And to understand what's coming next, we have to understand why Japan matters so much more than people realise. Most traders are conditioned to think that macro begins and ends with the Federal Reserve. If rates move, they think Fed. If liquidity tightens, they think Fed. If risk assets sell off, the assumption is always that something changed in the US. But Japan plays a very different role in the global financial system. For decades, Japan has effectively been the cheapest source of money in the world. While other central banks raised rates, Japan stayed near zero. While inflation became a problem elsewhere, Japan remained structurally deflationary. And while the rest of the world tightened, Japan stayed loose. That created an environment where borrowing in yen was incredibly cheap and incredibly attractive. This is where the yen carry trade comes in. And this is the part that most people underestimate. For years, institutions and traders have borrowed yen at very low cost and deployed that capital into higher yielding assets around the world. US equities, tech stocks, emerging markets, bonds. And over time, crypto became a part of that mix too. So when people say Japan doesn't matter for crypto, they're missing the point. Japan isn't just another economy, it's a funding source. And when that cost of funding changes, the impact ripples through everything that depends on leverage and liquidity. That's why even the possibility of a Bank of Japan rate hike gets markets uneasy. Because when Japan raises rates, even slightly, it changes the maths. Borrowing yen becomes more expensive. The margin on carry trade shrinks. The risk-reward profile shifts. And when that happens, traders don't suddenly become patient long-term investors. They start reducing exposure. And this is where crypto becomes vulnerable. Not because the fundamentals are broken, but because crypto sits very high on the risk spectrum. When leverage gets uncomfortable, risk gets cut first. There's also the currency side of this, which is just as important. When rates rise, currencies tend to strengthen. If Japan raises rates and the market believes it's a start of a broader shift, the yen can move higher. And a strengthening yen is not just an FX story, it's a global risk story. Because when the yen strengthens quickly, carry trades are forced to unwind positions. And unwinds are rarely neat or selective. They don't just sell one asset and hold the rest. They reduce exposure across the board. That's how something that looks like a technical central bank decision in Japan turns into a broader selling pressure across equities, bonds, and crypto. We've seen this before. Historically, when Japan has signalled tightening or policy normalisation, markets haven't collapsed, but they have become volatile. Risk assets tend to wobble. FX volatility spikes. Liquidity tightens and speculative assets often underperform in the short term. That's an important distinction, by the way. This isn't about crashes, it's about repricing. Most market stress events don't start with bad fundamentals, they start with liquidity shifts. And that brings us to the most important nuance in this entire conversation. This is not the 1990s. This is not Japan suddenly slamming on the brakes. Markets have known for a long time that Japan couldn't stay ultra loose forever. This transition has been discussed, analysed, and gradually priced in. So if Japan raises rates exactly as expected and communicates cautiously, the market reaction may be fairly muted. There could be some short-term volatility, some chop, some uncomfortable candles, but nothing structurally dramatic. The real risk isn't the hike itself. The real risk is surprise. Markets don't fear expected events. They fear acceleration. They fear shift in tone. They fear central banks suddenly sounding more confident, more committed, and more willing to tighten than previously thought. If the Bank of Japan raises rates and signals that this is the beginning of a faster than expected normalization process, that's when things get interesting. That's when yields move, currencies react, and risk assets start to feel pressure. And this is where crypto traders often get caught out. They see good news, they see ETF inflows, they see bullish narratives, and they assume price should go up immediately. When it doesn't, confusion sets in. But markets don't move on narratives alone. They move on flows, and flows are driven by liquidity conditions. Even in bull markets, liquidity tightenings at the margins can cause pullbacks. Even in strong trends, leverage flushes happen. And even with the best long-term outlook, short-term macro can dominate price action. So when people ask me, do you expect a drop if Japan raises rates? My honest answer is this. I expect volatility, not certainty. If Japan hikes and sounds confident about tightening, we could easily see a pullback driven by risk reduction and leverage unwinds. That wouldn't mean the bull market is over. It would mean liquidity is being repriced. If Japan hikes but reassures market, the reaction may be choppy and short-lived. Price could go sideways, frustrate everyone, and then move once positioning resets. And if Japan surprises markets by delaying or sounding extremely cautious, risk assets could actually breathe a sign of relief. Liquidity would remain supportive, and crypto could stabilise or even rally. This is why prediction isn't the goal here. Reaction is. Personally, I'm not trying to guess the outcome. I'm watching how markets respond after the decision. I'm watching the yen. I'm watching bond yields. I'm watching how price behaves, not what headlines say. Because the market always tells you what it thinks. You just have to listen. This is also why this time isn't for reckless leverage or emotional decision making. Periods like this are designed to shake people out. They're noisy, uncomfortable, and confusing. And that's exactly when most traders make their worst decisions. Zooming out, none of this invalidates the long-term crypto thesis. Japan raising rates doesn't kill adoption. It doesn't undo institutional interest. It doesn't change the fact that this is still a structurally new asset class. What it does change is environment. And successful traders adapt to environments. They don't fight them. So if the market feels weird right now, if price action feels heavier than expected, if rallies don't hold the way you think they should, this is part of the reason why. Japan matters, liquidity matters, and macro always matters more than people want to admit, especially in leveraged markets like crypto. This isn't fear, this is context. If this helped you understand what's really happening behind the scenes, make sure you like the video, subscribe to the channel and drop me a comment. I'd love to know how you're positioning into this week. And if you want to know the exact strategies I use to trade these kind of markets and the kind of strategies we use to make money in both the bull market and the bear market, we've made a completely free course for you. The link is in the description below. Thank you so much for watching, and I'll see you in the next one.